Hi, I'm Rod Mullis with the Ramsey Realty Group here in Keller Williams here in St. Joe. Today we have the pleasure of sitting down with Mandy Schrick from Mutual Savings Association, also here in St. Joe.
Yep.
And I've been looking really forward to sitting down with you, Mandy, and talking about these things because so the lending side of this is really, really important right now with everybody trying to figure out what the interest rates and so much of what's going on that's kind of got people somewhat taking a step back. Even experienced home buyers are seeming to stepping back right now, trying to figure out what's going on in the big picture. So I guess I wanted to ask you first off, what's going on?
Well, I can tell you where rates are at now and kind of where they were in the past. Of course, going forward, none of us really know. We kind of say a lot that it's kind of like the stock market. Everybody wants to talk about it, but nobody really probably knows where they're going. So the important thing probably in the environment that we're in right now is to get with an experienced loan officer. They can kind of sit down with you and give you all the perspectives and then kind of make the best informed decision you can based on that information, of course, that the realtor or that the loan officer has provided. Again, we don't know where they're going. Lots of different things that you could look at. One thing that people are usually scared to even address is looking at some sort of an ARM program.
Sometimes that's a bad word.
Yeah, that's a bad word, yeah. But in an environment like this, for example, you could do a 5/1 ARM, which is going to be fixed for 5 years, would have the option to adjust after that, of course. But the difference in the rates right now is huge. You can do a 5/1 ARM at 4.75 versus a 30-year fixed, which is at close to 6% right now. So depending, again, what your long-term goals are, if you're a first-time home buyer, you may only plan to be there for 3 to 5 years. So if you can take advantage and go with that lower rate, then you're saving yourself a lot of money in the long run.
Absolutely. So what on the ARM, how if the interest rates begin to drop in about 3 years, what can the consumer do at that point? Can they come in back in at that point?
And come in and refinance. And some people will tell you that they look for rates to probably stay up through the middle of next year and then maybe drop back down. Again, nobody knows for sure. But in that instance, at least you've taken advantage of the lower rate for a year or two and then can look at the refinancing. So, and the good thing is we don't have a lot of junk fees or extra fees. So to do that, you wouldn't have to pay a whole lot in closing costs again to do that.
Absolutely.
So, yep.
Well, and then that only puts you a 1.5%, 2% higher than what the lows were if you do something like that.
Yes.
So that could be a good option for a lot of people.
Yes. And again, I know, kind of back to what you said, it's kind of a bad word. Yeah. But in an environment that we're in now, definitely might be the most advantageous to go with.
What would the customer expect if the rates did go up? How much does it caps out?
Yes,
right?
There are caps. That's correct. They can go up or down each year is 2%. And of course, this varies from lender to lender. But the max they can go up or down is 2%. And then there's also a lifetime cap. So at 4.75, the lifetime cap would be 10.75%. And even if you're not a first-time home buyer, the average lifespan of a loan is 5 to 7 years. So chances are you're going to refinance, tap back into equity maybe for improvements or debt consolidation, or even sell within those 5 to 7 years. So again, not necessarily the program for everyone, but something that
it's worth sitting down and talking to you about this. So how does it work for me?
Yep.
What's going to work for me? What's going to work for my children? What's going to work for my
Yep.
So there's different scenarios for everybody.
Yes, and then on the fixed side, 5.5 or 6% in the grand scheme of things is not a high rate. It's just that we've been hearing 2s and 3s, of course, for the last couple years. So it seems super alarming. But again, a 5.5% rate is not a high rate.
No. and you don't want to miss out on something that you've always wanted, your dream home, your property, your opportunity, just over a couple percentage points that are off the low.
Yes.
Because it's still the right time to be buying home.
Yeah, and regardless where rates are, that's all part of the process. We're going to sit down and give you an idea, okay, if this is the range you're looking in, payment wise, then this is the range you need to be looking in sales price wise. So it's all going to be part of the process regardless where the rates are. Again, you just want to sit down with somebody that knows what they're doing and kind of work through that.
Well, I mean, most people every couple of years they go in and reevaluate their insurance, and they check rates and they get new prices and everything. This shouldn't be any different on this in the lending institution. We should be keep monitoring where those rates are at, and if it's beneficial for us to jump in and make a change.
Yep, absolutely.
So. I think one of the demographics that we're having the most trouble with understanding some of the lending is the new first-time home buyers. They're not sure that this is the right time to be jumping in. Should they stay where they're at renting? I mean, like we're seeing rental cost up as an average across the country at 14% across the board at an average, but as high as 30% in some regions. I mean, and I don't think a 2%, 3% increase in interest rates isn't going to equal that out, right?
That's correct. Yep.
So what would you say to the first-time home buyer to come in? What types of things would they be wanting to talk to you about?
Well, I mean, the first thing you want to do is get in and get that pre-qual and find out. When we do that, we're going to, one, qualify you maybe for the max based on your scenario. Right. Where is that? But the more important thing is payment-wise. If you're shooting for an $800 a month payment, then we're going to back ourselves into that and tell you exactly what price range you could be looking. And that may answer the question right there. If it's $800 a month and it's, we work in and back ourselves in and it's not what you're looking for, then maybe that says you hold off a little bit longer. Right. Oftentimes people will also find that they qualify for much more than what they're even interested in paying. Right. So again, the more important thing is where are you comfortable payment wise and what does that look like? Right. And can we get you there and those type of things? And does that get you what you're looking for?
Exactly.
House-wise?
Yeah. So. They're going to come in and sit down with you. Hopefully they're going to have some idea what they need in their life at this point.
Yes.
Where they're at and potentially where they're going to grow to as a young.
Yep. And then that's where you guys come into play. Once they have that information, that's where you come in helping them find that scenario.
And that's why this is such a important teamwork situation between the lender, the agent, and the client, that we make some good decisions and that we all stay on the same page and talk through this process so that we make sure that we're getting everything good the first time around.
Yep.
I was going to ask also, with all the changes that have happened with the interest rates and everything, the talks of inflation, recessions and so forth, are we seeing lending stricter, or are we seeing them less strict right now, or what should people be concerned with?
It is loosened up a little bit over the last couple years. I don't think we'll ever find, in my opinion, I don't think we'll ever find ourselves in the scenario that we were in 20 years ago. At that time, lenders were lending 100 to 103% of a sales price. Of course, when everything fell out back then, lenders as a whole tightened a lot. And so I just don't see us falling back in that exact situation. So a little more cautious than we were 20 years ago. And when I say we, I mean the industry as a whole. Right. But they've also, with that being said, have kind of loosened back up a little bit on some of those things.
Sure. And with the talk of recession, those things that happened 20 years ago, they won't happen again.
Yes.
We won't have that big dump because we put some stops in place, right? So we're going to have well-qualified buyers.
Correct.
This time. Last time, not everybody was well-qualified to do that.
Yep, and that's why I specify, definitely as an industry as a whole. And for Mutual in particular, all of our underwriting and stuff is done in-house. So we did a pretty good job there. If you're going to keep those on your books, you want to make sure that you're not putting the borrower in a position to lose, basically.
Absolutely.
You want to do the best job you can.
Absolutely. So. Talk a little bit about keeping stuff in-house. I think that's such a important thing for especially for all buyers, but especially first-time home buyers.
Yes. So Mutual Savings actually retains the servicing on 100% of the loans we do. So it doesn't matter if it's construction, purchase, investment. We keep everything in-house. And even on our Fannie Mae loans, of course, to get the low rates, Fannie Mae is where those low rates are. we still retain the servicing. And so, of course, the advantage of selling the servicing for a lender is that they get a servicing release premium, so they gain money on the sale basically. For us, we actually have 6 full service locations. So we keep the relationship because of those opportunities, for deposits and insurance and those type of things. If you've been through it, if you've been through a home being sold, firsthand kind of the horror stories that can happen. And a lot of times it's escrow, if you're being sold and it's being sold to an out-of-town lender and they're trying to meet 50 different states, tax deadlines and insurance payments. So those are usually the things. But again, for us, we feel it's more important to keep that relationship. So, and the advantage too is just that they will always get to call Mandy
Yes.
with questions. So if they're not sure on a payment, or if they want to change how they make the payment, or if they want to change their insurance, they're able to call me directly. Absolutely. And we'll get it taken care of. At the end of the year, important. Escrow analysis, those come out for us in December. And if people get those and maybe taxes went up and they're not clear, they're able to call and get a clear answer right away. Yeah. And not talk to a machine and, be transferred and those type of things. So that's the real advantage of
think that's an incredible
being able to
advantage.
Talk to. Yep.
Because I'm going to expose my whole life to you, throughout the loan process, and I'm going to partner with you.
Yeah.
And then I sign the paperwork. 10 days later, I get a letter saying it went someplace else. But in your case, whatever I'm finding, I'm calling Mandy
always,
every time.
Yep.
And I'm going to expect Mandy to talk to me as well about, hey, Rod, maybe this is time to look at refinancing.
Yeah.
Hey, interest rates are moving or whatever.
And even down the road, because of that relationship, when they're ready to sell and maybe move to their second home, they are comfortable because they have that relationship of somebody that was there from start to finish. Exactly. And beyond finish. So down the road for you and I and them, it's just a better scenario.
I absolutely
all around.
That is great. I mean, because I've gone through having my loan sold, and then resold, and then you're always chasing down.
Where do I make my payments?
Where do I make my payments? I know a payment's coming due. I don't want to make a mistake.
Yes.
Send it to the wrong company, and it's not getting addressed. And I know it works.
Sure.
But it isn't optimal all the time.
Yes.
And it's not for everybody. Some people, it doesn't matter.
They'll go. Yeah.
They've gone through it, they've done it, and it'll be fine. But the first time home buyer especially.
Yeah.
And I mean, some people just want it simple.
Yeah. Yeah. And some people still want to be able to talk to a human being. I mean, that's the biggest thing. Somebody they know.
Yeah. I want to depend on you to tell me, hey.
Yeah.
Because, I pay a little bit of attention to this stuff, but I mean, look, you're in this every day.
Yeah.
You're seeing everything.
Well, and it's the same thing, if somebody maybe just missed a payment, maybe they were out of town on vacation and, it's day 16, it's not considered late yet, but we look at those and we call and say, Rod, you missed your payment, did something happen? So it doesn't go 30 days late. When you're with a big servicer out of state, they don't do that. Yeah. They can't and they don't do that.
Right. Yeah. They just send that letter a few months
later.
later.
Yeah. By the way. Yeah.
Yeah. Here's some additional fees.
Yeah.
And
it's on your credit.
It's on your credit.
Yeah.
So the next time we come back around, then I'm going to have to explain that. Or
yes.
My interest rate gets changed because of something like that.
Yep.
One of the other things that I kind of wanted to talk to you just a little bit about is just what would you say to people at this point that are looking to go up in size versus just staying where they're at? I mean, you think you think it's a good time to continue to buy houses?
Yeah.
And take
yes,
loans? I
do, because there's so many different options out there. Again, back to what we said, depending on long-term goals, you've got those arms you can look at. And then again, we're not going to put you into something that you can't afford. Right. So the biggest take from this is that, just getting in and working through the process and again, seeing what you qualify for, seeing where that is comfort level wise. Again, we're not going to put you in something that you can't afford. We want you to succeed, just as much as you want to succeed. And back to, again, with us keeping the servicing, we want you to succeed. Like
Yes.
it's our loan forever.
Absolutely.
So we want everybody,
Yeah.
to
Looking for that long-term
Yes,
commitments and
yes.
long-term relationships here
yes,
for us
because
all.
if you fail, we fail.
Absolutely.
So that that's
Absolutely.
the goal, is to get you in something. And maybe it's not. Maybe we work it and run all the numbers, and maybe now's not the time.
Right.
But that's
And that's where we would need to depend on you to tell us that.
yeah.
Hey, this may not be best for you right now.
Yes. Yeah. Yeah. And
So-
most of the time, it, when you work the numbers and you have, as far as comfort level, I keep going back to that, but that's so important. Where is that for you? What does that look like for you? And can we get you there? So.
One of the things we see commercials about, our banks send it to us all the time, credit scores.
Mm-hmm.
Credit scores.
Mm-hmm.
Here's your credit score. This is where you're at with, you've got different reporting agencies. What should people come in there thinking their credit score should be? They think that's too low. I mean, where do you really think people should come in at?
I mean, ideally, kind of the ideal would be 660 or above. With that being said, again, we're a portfolio lender, so we can kind of think outside the box a little bit. If your credit score is 620, maybe it's strictly because of medical collections. Sure. We see medical collections a lot. And so if that's the case, again, we can think outside the box and say, hey, look, Rod makes all his payments. He's never had a late payment, but because of this medical situation, or, we find so often that medical are misreported or just missed, maybe the bill never was received. So with that being said, we can go as low as a 620, 640. And maybe even a little. It just kind of It depends on the scenario. But yeah, those low to mid 600s are usually.
I know some folks that are trying to get their credit repaired. I mean, we go through, as young people, start out, things happen, and you make mistakes, and it's all about learning and living and all that. But they're trying to figure out where they need to be at, and I feel like some people get a little bit paralyzed just simply by that, knowing what that credit score is.
Yeah, and the most important thing of all is working through that pre-approval process, because so often people think only credit scores. I just got to make sure my credit score. Well, there's a lot more that goes into it. Your debt to income goes into it. Your employment goes into it. So you might be working on this, and then lo and behold, it was really this that you should have been working on. So when we go through that process, if you're not there, we can tell you where those areas are and what you need to do to get those areas in line.
So also, is it the medical stuff starting to fall off the credit reports?
Yes, there's some big changes, and I don't know off the top of my head, but July 1st was a big change. January 1st of 2023 is a big change. So a lot of that stuff is going to be.
It's going to help loosen up the process.
And some of the stuff, and I can't remember the threshold. Yeah. But some stuff below a certain amount will not even show on a credit report.
Awesome. That's because, like you said, things just fall through the crack. They get in this
world. Yeah, and especially medical. Especially medical. So.
Absolutely. What would someone walking into your office, obviously make an appointment, just don't show up and expect you to see it, but what would they want to bring with them when they come in?
Usually what we do, and so much is done electronically now, a lot is not done in person, and a lot of times it's a phone call and can you email me what we need? But usually, it's going to be completing the online application, which is pretty straightforward. There's no cost to do any of that. And then there's usually three things. We want pay stubs, W-2s, and bank statements. We don't have to have all of that. Of course, the more we get, the better, because when I give you the pre-approval again, we want to make sure we've really worked through that and you've got a solid, number there. But usually just those few things. Awesome. So not a lot to it. There really isn't a lot to it. Yeah.
So if somebody wants to reach out to you to start the process, where are you located? What's your phone number?
We are on 71 Highway between St. Joe and Savannah. So that's the location wise. Of course, we have email. We have phone number, of course. That number is 913-758-4470. That's going to be the direct line. And then, of course, email or just dropping in, either way.
Website?
Website, yep, www.msa.bank is what that is. So,
perfect.
Yep.
Perfect. Mandy, I appreciate all your time here today. I'm sure people will have tons more questions, and we'll do this again as we get.
Sure.
I'll have more questions
Yeah.
when we get done here. But
Yeah.
I really appreciate your
Yep.
time. I thanks everybody for tuning in and listening to the beard and the brain. We'll go that way, this way. Thanks so much.
Yep. Thank you for having
You
me.
bet. Thank you.
So.